welcome to this very exciting webinar on the future of banking. Will neobanks become a threat? I think we have some of the most interesting speakers that we've ever had, actually. And I will ask you guys. I will actually ask you guys to introduce yourself, and maybe in addition to introducing yourself, you can also tell me your favorite finance app or your favorite app that you have on your phone related to finance. All right. So maybe Christine, why don't you go ahead and start?
Hello, Tony. I'm Christine Schmid, working for Additive. Additive is a embedded finance provider on the wealth side. It's not a startup anymore, I would say, serving clients globally ex the Americas. Well, honestly, the favorite finance app is something that brings everything together. I'm a big fan of all the cashback opportunities that help me steer through, like Stocard, for example.
So Stocard it is?
That's something I use quite often, yep.
Okay, cool. Jason?
Hi,
do you want to go ahead?
Jason Bates. I'm Deputy CEO of 11FS. Spent the last 8 years building Neobanks and new propositions. So I co-founded Starling and Monzo, two of the new digital challenger banks in the UK. And of course, Monzo is my favourite app, as it just makes me smile whenever I open it up.
That was an easy answer, right? David?
Hi, everybody. I'm David Breer. I'm the CEO here at 11FS. What was my favourite finance app? Probably a company in the UK called Snoop. Big fan of those guys. They actually do an amazing job actually making people better off. So they're constantly looking at transactions, the subscriptions, the utilities, and actually suggesting and enacting not just a here's the thing you could do, but fundamentally making it happen for people, saving them money on electricity and gas and broadband and all sorts of things. So super smart group of people. Really good founder in Jane Ann Gardner as well. So big fan of those guys.
Cool. Maybe before we start, actually, since we have a largely Swiss audience, so maybe I should also talk about us, the people who are hosting this webinar, Redesigning Financial Services. I would say we're the leading think tank in Switzerland that is entirely dedicated to the financial industry. But since we have a very Swiss audience, maybe, David, could you tell us a little bit about 11FS?
Yeah, sure. So
super short pitch, basically.
Man, I'm not sure I have a super short pitch, if I'm honest. The thing that we try and solve for people is firstly trying to understand what their problems is, because in a world that's talking about digital, I don't think many organizations really understand what that means. And there is such a dramatic difference between digitized and digital, and the chasm between the two of them is essentially what we help people understand. In that context, we've built in the last 6 years something like 10 challenges across the globe, whether it's Hong Kong, Singapore, the US, South America, all sorts of places. Really fulfilling what it is to be a different financial services player in that instance.
I will go actually off script right now, but you just mentioned something that I find super interesting. What is the difference between digitized and digital that you just mentioned? So
digitized is essentially taking a previous form factor. It's taking, banks were incredibly successful for such a long period of time. There was 300 years of success in the analog world, and that was fantastic. But actually what they've done with digital is digitize those previous form factors. So they've taken paper, they've taken statements, they've taken the branch and everything that brought, and tried to replicate all of those things in through a website or through an app. Our argument and our thesis for the industry is that digital is so much more than that. It can really fundamentally rethink what it is to be a financial services player in 2022, and that's really where we aim with those things. The virtues of digital are fundamentally different, and we can get into more of that, I'm sure, as we unpack it.
Perfect. But yeah, you're absolutely right. Maybe actually we should first talk about neobanks, right? And neobanking. So maybe to to make sure that we all understand what we're talking about. We're talking about digital-only banks, right? Not legacy banks, not established incumbent traditional banks, but digital-only banks. Maybe, Christine, since you're an expert on neobanks, what do neobanks really do better than traditional banks, if anything?
Well, see, you know the traditional argument, okay? They're simpler to use. They do the client experience better. And they've just chosen on one feature and do it way cheaper. Should just take the FX markup on the Revolut side. Yeah. Or what Currency in the UK is doing, just building on all the UK banks with a prepaid debit. You don't even need to open an account and no FX in global use. What they have missed a bit, and we know that they've grown above around 1 billion clients, but profitability is another issue. So the very, very limited number of neobanks so far is profitable. So they have to either have to grow from here or to find new models and way of serving their clients while not losing them, trying to become more profitable.
Yeah, maybe before we look actually into the future, just to better understand the context, right? We now understand what they do better. So you mentioned UX, you mentioned something like lower fees, right? In some cases.
Pricing, obviously, yeah.
Pricing, but there has to be something more. Like I guess was that enough to draw clients into neobanking? Like Jason, you've worked at Monzo, you've worked at Starling. Was that all? Like being a little bit cheaper, having a better UX, is that all to draw people away from their bank where they've been probably with their bank for many years, if I think about myself, but also people in my network, right?
Sure. So I guess this builds on both Christine and David's answers. That really, if the only thing neobanks can do is price a bit better, then they're in trouble. Like they're just not going to be able to take on the incumbents. It's impossible. So, but when we look across other industries and we talk about the innovator's dilemma, why do all of the largest incumbents with all of the capital, expertise, brand, customers, truly ridiculously huge companies, how are they surpassed by Netflix and Spotify and, the entire new wave of digital challenges? There's something in that. It's not pricing. It's not reach. Like people have come from very small companies to go buy the big incumbents. And so that for me is this question of digitizing versus digital. If this is a commodity product space, if a current account is a current account, a loan is a loan, then the big players and incumbents who are really financial product engines and distribution mechanisms for those products win. But digital is really about delivering intelligent services layered on top of commodity products. So what we're really heading towards is more like, and Swiss market, private banking for the mass market or the family office for the mass market. Because actually, if this is just about you holding my money in a vault, telling me what the balance is and the transactions and letting me transact, that's just a basic product. But if you're there actually to understand the brutal realities of my life and to create intelligent, event-driven services and opportunities that guide me and help me and make my life easier, combined with an operating cost that's a fraction of the big banks, well, then we're getting into interesting space because the challengers always win with a 10 times better service and a 10 times lower cost. So ultimately, I feel that's the direction that this isn't about just pricing, but actually it's about a change in operating model, moving from commodity product manufacture and distribution into an intelligent services space. Because in the end, you're right, Revolut isn't a bank in the UK, and yet is aggregating and bringing together lots of products in order to make that happen. So there's this new layer of players. And it's funny because when we talk about banks or neobanks, like banking is traditionally not about the business. It's about the business model. It's about taking deposits and lending them out. Whereas neobanks aren't really about many of them aren't about that business model as such, because many of them don't have banking licenses. They're actually about the doing the job, which is we get paid in salary, in lump sums, and then we have lots of disbursements go out in tiny, payments all over the place. How do we manage those things well? How does that work in the grand scheme of things? So it changes the meaning of really what is a checking account, what is a bank, and it also sort of points to where challenger banks and neobanks can get to.
Do you want to add anything on that, David? Because I just saw that you were almost jumping in.
No, I think we have to say this is from commodity analog products to intelligent digital services, and actually that change there is dramatic. I think the thing that many people sort of forget, and a lot of people are like, well, banks are dumb, and like, why don't they get this, and blah 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 blah. But like, most banks started with an incredibly customer-centric, idea, solving an amazing problem for a community of people in the exact same way fintech is starting now. It's just like 300 years of success has sort of dulled that purpose a little bit in terms of actually where they are and what they're doing. And now they're these gigantic, sprawling organizations with all of these particular problems and, sedimentary technology, rocks of all these things that kind of go together. So, the things that fintech have really been able to do for the market is exactly as Jason says, it's like that emergence of a different way of doing banking. But actually, the problem that they've solved within the big incumbent organizations is proven that there's a completely different way of operating, that, the 15 people who are, highly trained and highly motivated can do more than 5,000 people with all, infinity money, but the wrong processes, the wrong culture, the wrong setup. So, it isn't just a website and an app. It's a fundamentally different way of operating.
Can I add one additional point
Yeah.
as well? Because I think it's interesting about challenger banks and fintechs and startups or scale-ups not being profitable. Because if we pull that apart, there's the profitability of a steady state business, and there's also the fintech land grab that's going on, fueled by VC money. And we can't conflate the two things, because ultimately Revolut is probably a very profitable organization if it wasn't trying for global domination at the same time. So we just have to be careful by saying, well, these fintechs aren't profitable. Yeah, but when they're scaling a few 100% a year and building and building and building to take that land grab, actually they're spending investors' money on a future investment rather than making it easy for us to stand back and say, do the unit economics work here? You can't actually tell from their statements, just because they're sheer scale machines and they're being pushed by the market to be such.
But
If you go for the land grab, if I might add, if you go for the land grab, you might not need that many in the end. So there might at some point quite some concentration happening.
Definitely.
Exactly because of the behavior and the fast scaling that is needed to remain in the market, and at some point, obviously, to be the one then to price on the service you provide.
Maybe to add one point, also from what I see, I think a lot of neobanks are in a very low margin business, right? They're actually in the business, and that's why it's actually super interesting what you said, David, the difference between digitized and digital. A lot of neobanks, didn't they just digitize what is already there? Cards, accounts, payment, maybe a little bit of investing, but is it really something new?
I think many are evolving from a customer experience perspective, but if you look at where many are, and again the cycle's very similar, just none of us were around to witness it when the banks came about, was actually the beachhead for many organizations is an evolutionary step on the way to the revolutionary step that they really want to take in that sense. So, ultimately, financial services is an incredibly heavily regulated industry. The financial instruments are going to be the financial instruments, but the innovation is what we're seeing sort of further up the stack. Those services, the change that we sort of witness at that stage. But yeah, any new form factor has to imitate the previous one to gain adoption and gain scale. But the service will be the thing that actually really truly differentiates them. I mean, I would say if you talk to any big bank on, you talk to a UBS or a HSBC or whoever, would they take the same customer base for 10 times lower operating cost, which is where many organizations are functioning? Like Ralph Hammers at UBS said, snap your hands off right now, So I think the ability to kind of cross-pollinate the, traditional sense of controls and risk and governance and everything that goes with it, with the new decision-making approach to it, the iterating live, the test and learn, the fast dynamic of a digital business. That really is what we're seeing, the sort of great marrying of those two worlds in the industry at this stage.
Yeah, I mean, Facebook started at Harvard, right? It's just a college thing, Is eBay about Beanie Babies? Is Amazon about books? Everyone has to start with something that can be built now, understanding where you want to go in the future and building the sort of tech and the brand and the approach to do that. So I think we have to look at at how new tech businesses build a product, a small, very focused product to gain adoption, but with an organization, a culture, a scale, a technology stack that enables them to do much more.
Mm-hmm. Mm-hmm. And Jason, you once said that there's like 3 options, right?
Oh,
that banks will have in their
stuff back in.
And guess where I found it? I found it on Twitter, and it was tweeted like 6 years ago. No, I'm just kidding. I'm just kidding. I think it was tweeted last year, but I think I found it super interesting. So you said that successful banks in the future, they have 3 options. And I think it's still very relevant, so it's not going to be super critical. But you talked about this lean product infrastructure, which is one option, intelligent banking services, which you mentioned previously, and also app stores.
Sure.
Can you quickly explain these 3 models?
Sure. So I don't think they're options. I think they're inclusive. You actually have to do all of them, essentially. So my view of the world, our view of the world, is that the traditional monolithic big bank against big bank approach is giving way to platform layers that are competitive. And those platform layers are at the bottom, the rails, the way money and risk and information moves, whether that's MasterCard or Visa or cryptocurrencies, there's something there. On top of that is the product layer, and that's the traditional banking layer. It's maturity transformation, loans, deposits. It's traditional banking. But that banking in big banks costs you a few £billion to run and has 10,000 people running it. Whereas if we look at, I don't know, how an ETF might run with a 14 basis point, cost, we're going to have to run things phenomenally cheaper in order to make that run. New technology, cloud-based, great platform. And so that's my lean product infrastructure. Like, everyone has to get there, because if a big bank can't get there, they should be getting someone else to do that. Like, it's the cost of doing business, and you can't compete with me if I have a tenth of the cost with you. I will always win that game. So then we've got the services bit on the top. So we take the product, but that has to be wrapped in something. It has to be that virtual private banker for the mass market on phenomenally lean product infrastructure on great rails. And then beyond that, we go into the journeys. So how do actually you do embedded finance, or how do you embed mortgages in online real estate? How do you sort of take a variety of products and bring them into the place? So whether you do all of those things or one of those things or a number, we're seeing Goldman Sachs sit under Apple. We're seeing Klarna, perched on top. This isn't a one big organization versus another. It's these stacks, and we're starting to see how that market is shaping out.
Mm. And maybe Christine
here.
Yeah, sure.
The product layer you rightly so described as well will become increasingly open sourced, which means that on your build platform layer, you have a wide variety of solutions that you can build into services which you couldn't in the past and need to be orchestrated. And thus, I think the service for the clients, for the ones that do it right, will only improve.
Definitely. Well, choice is a great thing at that stage, isn't it? I guess the challenge in that very low level stage is that, any market where you see people sort of concede ground to that that level only, like the level of commoditization that kind of happens. Mobile network operators is always one that we sort of talk about. It's, you used to pick handsets based on who that was, but nobody cares anymore. It's just the logo in the top of the screen, and everything else is about the services, the software, the apps that you have much higher up that stack. So, I think that's why Jason's saying it's not, if you concede that territory, that's a scary place to be, because you're just playing a super low cost infrastructure play in that sense. And anybody who knows, big banks knows that's not their unique selling point in that sense, in terms of, super low cost infrastructure.
So taking all of this into account, who's best positioned to be successful in the future? If those are the three, not options, but what would be the right word? The three strategies, let's say. If those are the three strategies, who's best positioned to be successful in the future?
So we talk about this. Yeah, I mean, we talk about a lot about the banking battlefield. Like if we draw a graph and say, okay, along here on this dimension we've got number of customers, and on this dimension we've got sophistication of digital services, then obviously you've got the startups who are sophisticated without the customers. You've got the big banks with all of the customers, but a problem. And the answer is, like, no one's really well positioned. Everyone has their challenges. Ultimately, you need a visionary CEO who can see this coming along, and a chairman and a board who says, actually, we're going to need to reconfigure and make this leap into digital to make it work. Moving across that boundary from taking an organization at scale to being truly digital is scary, especially when you've got a share price and the markets are ahead of you, right? So I've spoken to some of the leadership at BBVA who have been in this journey since 2007. So that's a lot of digital transformation to kind of push along. And equally, you've got the the neobanks, the challengers who are growing rapidly, 1 billion customers, going up that page, but they've got their problems. How do you reach scale? Banking is a scale game, and how do you sort of make that work? So basically, everyone has their challenges. They're all heading towards the same point. I tend to put my money on the challenges, because I think actually scaling a successful fintech is easier than transforming a very large organization, and other industries tend to indicate that that's the case. But I think everything's to play for.
Are there any particular players that you could name where you think those guys could make it?
Yeah, I mean, just look at the people who hit in such significant scale. I mean, like Neobank, just this customer acquisition that they've done, Revolut, their ability to scale multiple geos and continue to ship features faster than you would have even thought would have been remotely possible for an organization at that scale. I think that's the thing. I think if you look at the ones that are principally doing best in that sense, they're the ones that actually look the least like big financial services organizations and the most like very large, very well managed product and technology service engines in that sense. I think particularly sort of touching on Jason's point around, it's usually the people, if you look at other industries, if you look at it wasn't which one of the incumbent players is going to disrupt the music industry, or who's going to disrupt the car manufacturing industry. Is it going to be Ford or Toyota? No, it was Tesla. So it's like, actually often it takes an outside kick up the arse for the industry to really change, because while most of the industry wants to change, it won't until it has to. We're now seeing, though, we talk about the empire striking back, as it were, in terms of the big banks. The big banks are responding already. This isn't people having their fingers in their ears and just thinking it's a website and an app. Many people in those big organizations are starting to really understand that only major structural change, major operating cost change, and major technological change will actually get them to, really stay relevant to customers' needs in the future as well.
Christine, being a former insider, do you think they will be successful?
They tend to move if they have to move, and before they tend to harvest what is there to harvest. Now, the big question mark you're asking here, when is it too late? That's certainly one of the factors, the economic environment on top. with interest rates starting to rise again. We all know that as well. Credit cycle, but also interest income helping. Will they make it? We always call, and I was a banks analyst for 16 years, change is normally happening slow till it really happens, and then it's fast. And I would say what I would look into is the ability to embrace technology and technology change, the ability to partner, and at some point, the ability to let go and felt cannibalize what you have there, and maybe work with 60% of your offering instead of 100% because 40% simply was loss making. Guess what? On the bottom line, it helps. So will they still be there going forward, the large ones? I guess so, yes. Will they look different? Of course, they will look materially different. They need to become technology companies. They need to partner. And if I might add, to two that ones that we think are good positions, certainly one is the Goldman Sachs, because due to their power, they have partnered. They sit on the Apple App Store. They provide the investment service on the back of that. It's a bit monopolistic, but nevertheless, it's a good partnership. And further, I wouldn't underestimate the technology providers that are able to fragment the value chain, so your platform layer, to rebuild it and to provide services on top in any journeys clients and non-financial brands like. So there are some non-financial names starting to grow nicely into be it out of the tech space, but also out of Asia.
Well, and that's interesting, isn't it? Because on that banking battlefield then, so what's the strategic advantage of being a big bank? Because actually, at the point where you're like, well, we've got loads of technology. Well, yeah, but Apple's better than you at that, right? But we've got a recognizable brand. C answer one. Apple's better at that, right? You know, so what's the strategic advantage of it? Like, we've got a gigantic balance sheet. Apple have got more money than you, you know, like, so the only real defendable position right now is that the regulatory environment is incredibly prohibitive and cost prohibitive as well for people to kind of move into those spaces because of that. Because on any other dimension, someone else does it better than them. You know, the balance sheet is no longer a strategic advantage. The regulatory environment is no longer a walled garden globally for players not to get into this space. So, I mean, it's difficult, isn't it? And to your point, Christine, I think the changing environment, you know, the new environments require, you know, new players, new rules, new setups around it. It's you know, in the same way as new evolutionary points require, you know, different type of sources on that. I think the biggest inhibitor, I think, for big banks, to your point, Christine, in terms of they'll give up the change, they'll give it up when they have to give it up. The biggest inhibitor is business model rather. So actually, you know, the difficulty is that most of the financial services industry's business model is antagonistic to customers. It's not beneficial to customers in that sense. There's punitive charges for overdrafts. There's penalising you for using loans. There's, you know, a long protracted gigantic loan for, you know, homes with mortgages and all the, you know, so actually it's really difficult to let go of those things because they're insanely profitable in that sense. And this is why many fintechs that are going into this space who are trying to do better when it comes to the benefit that they bring to the customer from an experiential perspective are looking at different ways of making money in that sense. So it's hard. Like, you know, your business model is a very difficult drug to let go of, you know.
It's about business model transformation, what we have in front of us for the next 10 years, at least, yep.
And also about probably, as you mentioned, cannibalizing yourself because otherwise others will, right? Maybe another perspective, because you both mentioned tech players. What is the role of tech players, especially like big tech players, the FANG or GAFA, or whatever you want to call them? What is their role going to be? Are they getting into finance? Are they getting into financial services or not? What do you guys think?
Tech players will get into everything eventually, because if if your skill set, your core ability is to do great technology at scale, then that's software is eating the world. That's a transformational thing, especially when you bring in artificial intelligence. When you've got that level of business model advantage, it can be applied to everything. So we could have this conversation on a webinar about anything: healthcare, education, commerce, you name it. We could be having the same conversation. So the question is not if, but when. Like, is it in the next few years for these players, and where does it fit? And they all have very different sort of big, whys. Google wants to organize the world's information. So you could see that a personal finance kind of version of something at Google Maps or Gmail or whatever, especially with PSD2 and open banking, is very easy to do and could be an amazing ad platform for them. So, there's an option. Facebook wants to connect people. So, it's all about social and communities, and finance does happen across those boundaries, and there will be payments there. Will there be mortgages? Probably not. So it doesn't quite fit with their brand and where they're going. Apple wants to own the ecosystem, every device that you own. And some of that is to do with payments and money and how that works. So it's not that they will suddenly become banks, is that they'll slowly eat at services that serve their why, their need, their push. And that surface will grow and grow as time goes by. And obviously, they have to show shareholders that they're going to grow much more next year than they are last year. They have to be taking new territories, and they're going to be obviously trying to expand in different areas and spin off new business units. So suddenly Google sits under Alphabet, and Alphabet, has a finance division, and suddenly they're taking software at scale and AI and data and software engineering and applying it to finance. Of course, that's likely. The question is, will other tech players be able to fight that with? In the meantime, can they make it difficult where actually suddenly you're like, are we really going to go against Klarna when they've got such a big market impact? It could be costly to try and displace them, which is why this land grab is so important. People know that once you're sort of there and have established and grown the network, then someone has to offer a step change of improvement in order to displace you. And I think that's why we're seeing so much money pouring into these kinds of things, because everyone wants to get there and establish themselves before the bigger players come along. Sounded like Game of Thrones.
It did.
but as far as I understand, and as far as I understand, after this half an hour of discussion that we've had, all of what we discussed is very much linked to retail banking. What about wealth management, private banking, Christine? Do you think that, because it seems like wealth management, private banking until now was quite immune to disruption. Would you agree?
On the really high-end side of the client, you could say so, but it was a massive shift in terms of the asset classes towards alternative investments. On the lower-end side, definitely not. So kind of the topic of financial well-being, the help from budgeting into 3 months emergency savings, help to find out what your pension gap is, then the move down of financial planning more into the masses, which is a part of the financial well-being side. No, certainly there are a lot of changes happening. And what was only for the richer ones, so kind of for the 10% of the population, is slowly but surely becoming available for the rest of the society. And it's needed. It's needed. We have longevity. On one side, we might have a bit of volatile markets, and the gap there. And therefore, these models are growing. And they're not growing per se with the banks. They're growing through the likes of, take for example, Grab starting to go into investments. Look at Acorns, how they started in the US. They were to reduce student debt. You're way closer to it. It's a decent 401k player now. So no, there are changes happening on the wealth side.
Definitely. I mean, look at, Free Trade doing investments, Robinhood, you've got Pension Bee over in the UK doing amazing things and scaling massively. I think it started in payments because payments was simple. It moved to retail banking because retail banking was simpler. SME came after that, and that was the wave. But, we're getting now into the meaty, complex, very large revenue generating parts of financial services. It's, corporate banking is on the horizon, but wealth and mortgages is where the sort of evolutionary steps are today. So it's exciting to see those things, though, because it's kind of dealing with the much more complex issues to come about. And increasingly, back to what we were saying about those financial systems at that level, it's one thing managing an SME account for like 3 people and, no revenue. But when you're dealing with the complexities of an international business for a corporate organization, then it's very different. So yeah, I think it's just the point in the cycle that we're at in terms of the emergence of technology being the dominant way banking is actually fundamentally operated.
If I take additive as one example, 12 tech, and the demand there, I would say it's at an inflection point now where it has started last year. It is there. It's a combination of wealth, it's a combination of insurance. Financial planning will be disrupted, and the business models are evolving very, very fast. And this goes beyond the traditional asset classes, but also then it's a way different topic into new digital asset classes and technology opportunities there.
Yeah, I think the other thing on that I think is super interesting, like new classes, like everything that's happening with cryptocurrency is like, that's just blowing up people's view of what investment really is in that sense, in terms of NFTs and all the things that are kind of happening around that space. I think the interesting thing if you look at big retail banks' reaction to it, it was getting into a really cold swimming pool. It was like they sort of eased their way in that sense and sort of got used to the uncomfortable nature of it in there. But what we're seeing with wealth adoption is it's freewheeling down a massive hill because money changing hands is not with retail, they had the ability to slowly adopt to the change in landscape and the competitive sense that's happening. But actually with wealth changing hands faster than ever before in that sense, then you're finding generational wealth moving from, 70-year-old with very different expectations of what the world is to a 23-year-old who's living in 2022 and a very different level of expectation of what those things are. Wealth players who don't offer the services that those guys want to see, who've got no relationship with family other than, some dude who turned up to your house every couple of years, is very, very different in terms of actually like managing that. So I think the backlash we're going to see in the wealth space, in the private banking space, it arguably is going to be more severe than what we've seen in the retail and the SME space, just because of the speed that it'll actually happen.
But it's not only the 25-year plus, it's also the 50-year plus, because if you have wealth transfer happening with the life expectancy, it's the 85 towards the 50 plus, then the next generation. Never forget kind of the low end side of the boomers.
Definitely.
So you think there's talking about the needs of the clients, because I think ultimately that's what we all want to do, right? Like fulfill the needs of the clients. Do you think there's like changing needs when we look from the 85-year-old to the 50-year-old, certainly, but also from the 50-year-old to the 25-year-old? Do you see like different needs there?
I was going to say I'm going to approach this a slightly different way. Like when we talk to, we probably do more work in wealth now than we're doing almost in any other sector. I agree with Christine. It's just going crazy. And the traditional approach when you went in to talk to wealth clients or sort of wealth banks, they'd say, look, this isn't going to happen to us because one, people like people. It's all about the relationship. It's all about the financial advisor. And secondly, these things are really complex, multi-jurisdiction, various asset classes and all that kind of thing. But of course, what they admit is they're also expensive. I mean, when you're paying 1% or 70 basis points, 50 basis points for someone to manage something that Vanguard will do for 20 basis points or less, then it starts to get interesting. And so there's a protection of actually the things we like and the things we don't think will shift are also the things that we charge the most money for and we charge assets under management. There is no other model. So it's like, oh, okay. So there's this really complex thing of the way that they charge, the service they give, the expectations, and the way that sort of space works. But of course, we've got self-driving cars now. We've got rockets that land themselves. Like, I don't think the fact that you're in a few jurisdictions and have a few asset classes is really a problem that technology can't solve. I don't know whether you've caught up to today. And then the human element is interesting because empathetic product design can really actually give almost a better response than an FA who's looking after 30 other clients and might look at your portfolio every few months. And that combined with then a lower cost to serve and lower fees and fee compression beyond which wealth banks can give start to create some real problems. So do people have different needs now? No, they've always had needs, but a lot of those needs have never been looked after by a wealth bank because, you handle your day-to-day, your 3 houses and 15 staff and everything else. We'll take your assets and invest them. But I need help on my, managing all my dependents. Well, that's not really our job. Like, that's for you. So people have had these needs. They're not satisfied. They work within this sort of strange, interesting model of assets under management, personal attention, but not really. And people are, and that prestige. But that's very fragile as a model and is definitely open to disruption. So who's more open to that disruption? Are people in their 50s? Less so. They're less likely to take a risk. But that's changing, especially with COVID, that has now pushed more and more people into doing much more things online than they would have done, 5 years ago. So I think that whole space is open for disruption. The digital shift across society is accelerating, and there's definitely a space there to do 10 times better service for 10 times lower cost, which is the key play.
Is that what you're referring to, David, when you say that digital banking is only 1% finished?
A little bit, yeah, a little bit. I mean, when building on what Jason was saying, I don't think it's a change necessarily of the needs. I don't think the needs are fundamentally shifting. It's the change in expectations in that sense, because the market is creating a very different level of expectation based on every other industry providing much greater sophistication of digital capability. When we say, digital banking is only 1% finished, what we really sort of mean by that is the level of change after, a couple of 100 years of the industry is only really scratching the surface about what's going to happen ahead of us. So, as much as it sounds like a low blow from what are you guys doing? It's actually a nod to the fact that we're really excited about what the next 99% of that journey is, and that there is far more of the industry to develop ahead of us than there is that we've seen before. So, with all of this technology changing, competitive landscape shifting, and everything we're seeing globally from regulators regulating in a very different way, then actually we've got huge opportunities to serve customers in ways you wouldn't even have dreamt of like 10 years ago. So that's why we're saying that. Also, what we're saying when we say that is like, look, this is not statistically quantifiable. Like, this is not we get asked questions every 6 months or so. Is like, are we at 2% yet? Like, and we do occasionally joke about making a breaking news announcement. Still 1% finished, guys, because actually the mindset that bankers need going into this period of flux is that kind of what's made you successful is probably not going to make you successful in this next era. And if you have the sort of emotional ability to go, we're brilliant at some things, but actually the game has changed and therefore we need to be brilliant at other things as well. That's what 1% finished is for us. It is we're constantly changing, we're constantly iterating, and because of that, actually change is always afoot.
Super interesting, which brings me basically to the next topic, which is the topic of talent. So we often hear that there's a war of talent. Obviously anecdotal evidence, but when I talk to students, very few of them want to work for a bank. So is it like, am I wrong? Is it just me? Or is it getting more challenging for banks to attract talent? And what do they need to do to do that? Because a lot of the people, actually, a lot of the young talents want to go to a fintech. Maybe they want to go into tech, but banking is more like a 6th, 7th, 8th option, I think.
I don't know. Yeah, look, we're about to go into like a major meltdown from a global industry perspective type thing. What looks like it's sexy and exciting to go into as an industry and what's a sensible career choice is probably not the same thing in that sense. So I wouldn't have said I wanted to go into banking when I was a kid either, but look at me now, you know. So I kind of think the idea of, you know, stability, banks have to be stable going into a, you know, global recession, which inevitably we are. It's not a bad shout from an industry perspective. My dad said when I had to pick a career, pick an industry that you think will take at least a decade to fix, because by the time you come out of your education, you're going to need somebody else to have fixed it, right? So financial services has still got a decade or more ahead of it with all of the different slices that we've talked about to really get its act together, to really be able to service people in the way that they want to. So, yeah, I mean, I couldn't more strongly advise people to get into financial services because it's a huge industry. It's got huge problems, but actually you've got really smart people trying to eat away at all of those different angles. So I sound like I'm doing a career show for financial services at this stage, like join Goldman Sachs. But I do think it's a great industry and better now than ever before. Like actually 10 years ago, you'd be playing around with putting chips in a bit of plastic people carry around with them. Now look at what we can do. So, and actually the fintech slices on it, you know, I've learned more in organizations that have been like not great from a cultural perspective or from an operational perspective or I joined banking in 2008, about 3 months before the crisis kicked off. I learned an amazing amount, you know, like, so, you know, what you want to learn in your career is not just to go and work at an Apple or a Google where you get a scooter and free lunches. It's like, you know, you need to go and work in places where you fundamentally learn how the industry works. Because actually, if you walk around banking, there are so few people who fundamentally get how financial services works. And that can be your strategic advantage, bizarrely.
I would fully agree with you, David. We fully agree. I think where change is happening, and in particular, if you look at the whole ecosystem that financial services are in, it's at the brink of technology. It needs to change to allow the transfer towards hopefully a more impactful society. It's like the fuel in the middle, and therefore it is an industry that needs to change. You can learn so much, no matter in which angle part you're gonna join. And this might take longer. Yes, fully agree with your analysis of the next 10 years. This will take longer, but it's a great path to learn a lot.
Yeah. Because of the number of industries that are being disrupted, you need smart people that can look at systemic, holistic issues and find elegant solutions to them, and design and code and product manage and do all of those things. And so we're not looking for bricklayers. We're looking for architects that can lay bricks, do plumbing and electricals and everything, and design all of that and be a structural engineer at the same time. Now, there are not that many people who are like that, and every industry is looking for them. And that's really the problem, because to really make the biggest impact, you need people who can really take so much into account and have such a broad breadth of depth of knowledge that they can create the next 100 years. Because when we're in mature industries, then sure, I can hire someone who's six levels below. They can crank their handle and, you know, the whole machine moves along. We don't have the whole machine. We're building that machine. So there isn't a space to have down there. So there is a problem with talent, that the number of people who can do that, who are that kind of shape and skill, are way fewer than every industry needs. So then the question, so then that's a market power shift. Suddenly it's not the big company saying, okay, graduates, come to me and there's 5,000 of you in the bucket, but I can only take 50. It turns it around and says, actually, what do superstars want? And they want autonomy, they want to do meaningful work that's actually going to have an impact. They want to grow and build skills and have kind of mastery and all of that sort of, all of that stuff. And so now it's what I find interesting is, especially with our clients, the change in HR from actually is not about writing a job description, putting it out and interviewing 20 clients. You've got to go out and spearfish people who are amazing and then convince them that they could join here, have autonomy, create meaning, impact the lives of, 50 million people. And away we go. We're building that team. And that's a shift. That's a shift in how you view talent. Is everyone fungible, replaceable? Every graduate I could replace? Or is this more like a Premiership football team that actually it's a small team sport, there's only so many people on the pitch and I need to find the absolute best, and if I do and I pull that team together, we will be able to achieve way more than anyone else in the space. And I think that that paradigm shift in how you might view human resources, talent, and how that kind of works is really important to get a hold of if you're going to make the kind of changes we're talking about.
You talked about
Sorry, Tony.
No, go ahead.
It is the football team, and thus it needs to collaborate, and you need to change the incentivization systems. And I think that's something really the banks have fast to look into, because it is too siloed still.
They do that on the trader side, right? Where they know that there are some traders who are 10, 20, 50 times better than anyone else. But do they do it on the technology side, where actually there are people who are 10, 20, 50 times better than anyone else? So it's an interesting, space to look in.
Christine, can you elaborate on the incentivization part or incentives part?
The aim is really that in a mindset change, as was alluded before, you achieve the targets as a team in a learning culture. If you have certain superstars that might be fine in certain functions, but other than that, it is really in the end not only the gain for the clients, i.e., and then the whole bottom line of a company. It's not only your business slice, but the bottom line of a company to drive it forward. If your unit is fantastically successful, but you're not collaborating with another unit, and therefore the overall result it doesn't equal the sum of it, then we're in trouble.
Yeah, and that sort of competitive nature internally for that doesn't join up particularly well from a customer's perspective, does it? It's why different systems for different business units don't talk to one another. It's why every answer leads to a product sale rather than the service. And from a customer's perspective, and we say this, it's like this is the shortcoming of digital. Digital is self-service. Actually what we've done is we've removed the people who helped people traverse incredibly complex financial services landscapes and acronyms and all the problems that they're really dealing with. And what we've exposed to people is a self-service element of different departments vying for supremacy and your eyeballs to buy their products. That's not great. That's not a good service. That's not a good experience, and not really something that helps consumers. I think it does come back to what we were saying earlier on around expectations and actually just a sad reality. And I remind myself and I remind as many people about this as possible is we're weird. We're talking about this stuff and you guys are listening to us talking about this stuff because we're really passionate about financial services. Most people don't care. No human being wants to engage with these things. It's like a massive pain in the butt that they have to do it on a Sunday or, learn how to do these things because it's complex and nobody cares. So businesses need to make it easier for people. They need to provide services to people. They need to give them, good advice, good guidance within the regulatory boundaries and everything that goes with it. But they need to provide a service that actually makes them better off, not self-service that allows them to make the mistakes. That's just not helpful. So I think it's resetting levels of expectations because, as Jason says, we've got self-driving cars. Like, how hard can this stuff be?
I think this really relates to what you, Christine, call jobs to be done, right? Can you tell me a little bit about the jobs to be done mindset?
Well, to turn it upside down. Literally in the past, you look kind of what do you need to do in the end to fulfill your targets on a P&L side. You need to turn it upside down. The jobs to be done is from completely from a client perspective. What helps the client and what is the service that serves it best is what you need to build. And clearly, these can cannibalize the way you run it today. And then you have to go into the discussion and decide to turn it around and to change it. This is what we are, and we discussed it before on the wealth side. This is what is starting to happen. So you move wealth, for example, at the point of traffic, where it's contextually relevant for your clients. So take, for example, a super app. Where clients are, be it on mobility, where clients are, be it because of their consumption, where you have a lot of traffic where you are anyway. You could do roundup savings. You might have even a point system behind. You could give advice, you could incentivize, and you could help to save up. It's the other way around. Is this service provided by traditional partners today? Partially, maybe, because banking as a service is one of the concept helps, and that's the regulatory tricky part. But as well, this is breaking up, so you can bundle and rebundle the whole value chain underneath and provide it into a journey where it's relevant for the client and where it's easier to use. So not the Sunday evening, oh, I have to do my financials and pay my bill stuff. This needs to be gone. That's boring. Completely agree.
So what you're referring to is also like embedding financial services, right, into non-financial activities. Basically, that's what you're referring to, as far as I understand.
This is one of the options. Yes, exactly. Embedding it, but also then underneath orchestrating it to such an extent that it makes sense.
Mm-hmm.
I was going to say, I think. Where is the end point to this? Will all financial services be embedded? No, I don't think they will, because there are some financial services that belong at the point of need. So payments, escrow, insurance for particular items, credit for particular items and payments. Like all of those things belong at the point that you buy the thing or think about buying the thing. And that includes mortgages. You look at buying a house, where you look at buying the house should be probably where you look to how to finance it. Okay, so there's a whole class of financial services that won't be on your banking app. You're not going to download a banking app to get a loan to buy a new laptop. You will do it at the point of need. But there are financial services that the point of need is not external. So day-to-day financial management, we're all paid with a salary check, and then we have to use cards and payments and direct debits and standing orders, a variety of things in order to move that money. The point of need is that banking app, is the day-to-day management of that. So there's a locus, there's a constellation of services around day-to-day financial management that don't end up in a store, they end up in a certain place. But there's also other constellations, mid to long-term finance. Do I want to look at my ETFs, pensions and ISAs while I'm doing my day-to-day financial management? I really don't. That's a separate mental context for me. And so you can look at social media. Why is LinkedIn separate from Facebook or Twitter or Snapchat? It's because mentally they're different spaces. They're the same kind of features and functionality, but it's business, or it's me, it's me and my family, or it's me and my friends. So the contextual separation and aggregation of services will belong, in particular groups. And then there will also be embedded financial services. So it leads to interesting questions for fintechs that do, a pocket money app, because that's not a center of control. That's part of day-to-day financial management. So that's going to be swallowed at some point. So you either take your pocket money app and grow into that, or you sell it to that person, or you find some way of exiting that business in the next few years. Because there are some beachheads Revolut starts in a travel card and then suddenly becomes everyday financial management. Monzo does, Starling, everyone does, you know. Or you start, I don't know, and then grow into we started in, money roundup savings, and now we're doing ETFs, and now we're doing, robo advice, and suddenly you're into that category. But I think ultimately they're the end points, that you end up owning one of these contexts or you end up embedding, and that's it. There is no naked financial product. They're all connected to some kind of end service or journey.
Isn't that a beautiful last word? Isn't that like perfect ending to this webinar? So I think the bottom line, and actually my biggest learning today was, in the beginning, I was expecting a webinar on neobanking versus traditional banking, and then I realized it's a very limited viewpoint. It's almost like thinking of financial services in terms of products, right? At the end of the day, what I learned today is it's not about neobanks versus traditional banks versus tech players or super banks. It's much more like this holistic approach that you guys also mentioned. I think that's for me the bottom line. Is that correct? Did I get that right?
100%. Yeah, no, completely agree. And the beautiful thing in that is that the customer benefits from all of this, right? Actually, the services, the products, the competition, all of those things just drive much greater outcomes for the customer. And arguably, I mean, that's why all of this competition was created in the first place. The changes that we saw post-crisis last time from a regulatory perspective have led to, greater outcomes for customers than ever before. But we're just scratching the surface. It's 99% of the journey to go, right?
It's about business model transformation to stay relevant, and it's speeding up.
Very good. Thank you very much, David. Thank you very much, Jason. And thank you, Christine. I think it was super, super insightful, this webinar. And actually, I would love to do a follow-up at some point where we get maybe to talk about a topic that we didn't really get to talk about, which is culture, which is actually something that is hugely important, I think, when we talk about the future of financial services. Maybe we could do that in the future. Until then, I thank you again, wish you a great afternoon, and thank you for tuning in.